I'm David True. Many of you know me. I'm president of NYPAY. Thank you very much for showing up. I understand the topic here was proposed because the CFPB was supposed to have issued what's the right word? The suggestions, the rules. But fortunately, we didn't base the whole thing on the idea that the CFPB rules would have been issued because I guess they've been postponed again. It will be a very good discussion. First, I wanted to very much give thanks to OREC and introduce to Brian Margolis a moment. OREC has been extremely helpful in providing us the space when the space we had prior became unavailable. And so I'll pass it over to him, and then he will allow me to pass it on to Christiane to get the event kicked off. Thank you very much for showing up. And if you've been to NYPAY events before, you know that questions are always welcome and encouraged.
Thank you, David. My name is Brian Margolis, and I'm a partner here at OREC in our corporate group. Let me tell you a little bit about our firm. OREC is a worldwide firm that has offices in 25 locations in the United States, Europe, and Asia. And we are a full-service firm representing both small and big companies in transactional and litigation matters. Our corporate group represents a whole variety of companies ranging in size from literally the proverbial two guys in the garage up through major Fortune 100 companies. Relevant for you folks, we have a whole practice group called the Technology Companies Group, which represents private companies ranging in size literally from very, very small companies that are doing formation and their first financing up through very, very well-established large companies such as Pinterest. In the fintech space, we have a variety of clients, also ranging in size from very small to much larger. Some of the clients we have in the fintech space that you've probably heard of are SoFi, here in New York, Betterment, and Prosper. So we have a variety of clients that are in the space, as well as many others that are smaller, and we always look forward to working with entrepreneurs. I should mention we actually do a series of programs like the NYPAY programs that we call the OREC Total Access programs, and you can certainly Google that and sign up for our mailing list. And that's a series of programs that we do geared for entrepreneurs and for folks who work in the entrepreneurial space, financing sources and consultants. And they basically have a variety of panel discussions, small group sessions, and other networking events that are very helpful. And so we encourage you to check out OREC Total Access and sign up for our mailing list. So without any further ado, let me turn it over to Christiane Gennaro, who's going to be the moderator of tonight's panel.
Thank you. All right. Can you hear me? Yes. All right. So if I wander away, I said the danger of having me not sitting down is that I'm going to rock back and forth or tap on the mic, so feel free to offer coaching advice. Let me just say, first of all, that we actually are webcasting tonight's discussion. So welcome to our webcast viewers. And for our webcast viewers, you are able to ask a question or interact with each other using Twitter. Please post to Twitter using hashtag NYPAY, NYPAY. And at the completion of tonight's webcast, those who are online can complete a survey. And I would encourage those of you who maybe in the future can't attend in person, check out the live stream because it's a way to be involved in the event if you can't be here in person. All righty. Anything else technical or logistical that I need to announce? I think we're good. Okay, great. So I'm very excited about tonight's panel. We had some great prep sessions. So let me just kind of outline what I think we're going to talk about. Of course, the panelists and the audience will help to redirect that. But what we want to do is take a look at what's going on with the CFPB in terms of their rules. We're going to start out with a little bit of the lay of the land. What's the regulatory environment? Why prepaid? Why consumer protection? Why now? Then we'll talk a little bit about, from the industry perspective, of what is there to like and not like about the proposed rules. And then we'll have two practitioners talk about how do they see the rules, how are they preparing for them, and how do they see that potentially impacting their business. And then at the end, I'll ask for predictions and prognostications. And, we always have time for questions at the end, but if you have questions in between too, we'll do a balance of the both. So let me first start by introducing Alex Gassner. He's co-founder of One Financial NB, where he currently serves as its CFO. Let me tell you a little bit about One Financial. It's a venture-backed laboratory for innovation in retail financial services. And at One Financial, they're deeply committed to building products that work for everyone and to passing the returns from innovation on to their customers. Alex himself specializes in partnerships and new product development. You always wait to see, like, am I going to describe you having a role that you've never heard about before? So far, so good. Good. Okay. He previously worked for Oliver Wyman's financial services practice, where he focused on retail banking and consumer financial services. He earned a BSE with honors in mechanical engineering at Princeton. So next to him is Brad Faust, who's the president and CEO of the Network Branded Prepaid Card Association, NBPCA. It's a nonprofit trade organization dedicated to educating, advocating, and protecting and promoting the prepaid card industry to government, media, and consumer audiences. He served as an advisory board member or as director of the NBPCA since 2006 at its inception. He is a nationally recognized payments lawyer as well, and business executive with more than 15 years of experience. And there's a long list of companies in senior leadership positions, but I'll mention Brightwell Payments, TSYS Prepaid, and Global Payments. To his left is Barry Kessler, also a seasoned veteran in the prepaid industry. From 2003 to 2007, he led the general purpose reloadable solutions group for Clarity Solutions, which was acquired by TSYS. You get the sense everybody in the industry knows each other and has probably crossed paths several times. Okay.
And we actually worked together for several years.
Yeah, exactly.
A
And
couple
now,
of years at least.
when he left TSYS, Barry formed Prepaid Resources, a leading provider of referral opportunities and middleware applications to prepaid program managers. And he headed up Trefoil Technology, an innovator in direct deposit acquisition and retention. And most recently, since 2015, Barry has served as GM for Praxel, a leading prepaid program manager. He's also, has a lot of great experience, has worked with many notable clients and card programs, a couple of them that I'm sure you guys have heard of: Green Dot, NetSpend, MoneyGram, MetaBank, Easy Cash Express, and others. And at the end of the table is Tom Scanlon from Davis Wright Tremaine. Tom focuses on advising financial institutions, tech companies, merchants, and investors on matters relating to regulation and financial products and services. He has significant experience in counseling clients on adapting their products and services given the regulatory landscape and helping them to prepare for examinations and guard against enforcement actions by federal bank regulatory agencies, including the CFPB. Earlier, Tom served at the Department of the Treasury, where he worked as the principal Treasury attorney who drafted Title X of the Dodd-Frank Act. Not sure if that's good or bad. Earlier, Tom was with, Morrison and Foerster, and before that, counsel at the Board of Governors of the Federal Reserve System. So I think we have a really illustrious panel. I actually like to read the bios because if I let people introduce themselves, it's kind of awkward for them to give really the long list of tremendous accomplishments. But I really appreciate all of your time here in preparing and then coming to be on our panel tonight. So let's get started. We have a little bit orchestrated. I'm sure we'll end up deviating. But Tom, you were going to kick us off. We talked about this during our prep session. Give us a little bit of the environment about the CFPB. Why are they focused on prepaid? Kind of a little bit of the genesis and kind of what you see as kind of the motivation and direction behind the prepaid rules.
Sure, I'd be happy to. Hear me? Only the people online could hear that.
Yeah.
Right. Better?
No? Can you pull it on a little closer? Pull it a little closer to you?
How's that?
I see a green light, so. Try now.
Yeah, we're live.
Yeah, very good.
We're live from CBS headquarters in the office and at work.
There you go. Never go tomorrow.
That's right. Does not love it. Today, in 2016, we find ourselves facing a situation in which the Bureau is ready to issue a final rule to regulate an instrument that's a prepaid card for all of us, a general purpose reloadable prepaid card under a term that had been proposed to be a prepaid account. And before I describe in broad themes how the Bureau is finding its way through this regulatory landscape, perhaps just a few words on the underlying Electronic Fund Transfer Act, as well as the Consumer Financial Protection Act of 2010, because this particular rule, in my estimation, is at an interesting cross current for consumer financial products and services. In the 1970s, just as a credit card was becoming more widespread and more commonly used by consumers for retail transactions, Congress and others were wrestling with the idea of how to actually make an electronic payment work. Not in terms of how to make an electronic payment process, how to persuade a consumer that the plastic, if lost, would not result in a loss of real assets to the consumer's checking account. Because in broad themes, the Electronic Fund Transfer Act is about protecting value, which from the perspective of a consumer who could write a check and whose signature on the check was the authorization for which the bank had to check, right? Is the check validly made by the drawer before funds are paid out? The loss of the plastic potentially puts the assets at risk and would disable the consumer from paying rent and paying other vital bills. Now, decades later, we find ourselves in that same environment of protecting assets, but with an additional set of interests, because for a variety of reasons, which we'd be happy to explore in this evening's discussion, many consumers use prepaid cards in order to effect regular transactions. And if we think about traveling, as I did recently first to San Francisco last week and now to New York City, the various arrangements that need to be made for an ordinary consumer to reserve a hotel room, for example, could not be made over the telephone by saying to the person on the phone, "Don't worry, I'll write you a check." And no one is going to put cash in an envelope and mail that to the hotel to reserve that room. But for a consumer who does not have access to a credit card, and for whatever other reasons, which we'd be happy to talk about as well because they're linked to a checking account, doesn't have a debit card linked to a checking account, a prepaid card is an ingenious device that enables an ordinary consumer to actually participate in these routine transactions that many of us who do have credit cards take for granted. Well, now what to do? That prepaid cards are everywhere. One of the key issues in this proposed rule is how much should the card cost? How much should the card cost to purchase? How much should the card cost to use? How much should the card cost when funds are reloaded? And oh, by the way, where are the funds going anywhere? Right? Those are central issues that now in 2016 are brand new and never were thought of in the 1970s when the Electronic Fund Transfer Act had been enacted. One of the interesting wrinkles on the Bureau's action here, and for just to be clear for everybody, when originally enacted, the Congress delegated to the Board of Governors of the Federal Reserve System the authority to prescribe regulations to implement the requirements of the Electronic Fund Transfer Act. And in 2010, those authorities, with certain exceptions, were transferred completely to the Consumer Financial Protection Bureau. And the Bureau, separately under the Consumer Financial Protection Act of 2010, is permitted to prescribe rules about disclosures. And so where the Electronic Fund Transfer Act originally was concerned about alerting the consumer to the rights the consumer has to stop unauthorized transactions on a lost payment device, now the Bureau's interests are taking that core interest plus how much should the card cost into account, and have proposed a rule that the Bureau has proposed a rule that would require the issuer of the prepaid card to provide certain disclosures describing some of the features of the card as well as the attendant costs.
Okay, great. Thank you. So we're going to do a little bit more background. Brad, I think you were going to talk with us a little bit about, dive a little deeper into the rule and some of the things that you think are okay, make sense, consumer protection-wise, and some of the things that you think are really going to have unintended consequences. So maybe you can tell the folks about that.
Great. And I'm not sure if my mic works. I don't have a green light. Can you hear me?
Yep, good.
Perfect.
Resonant voice.
Perfect. All right. So, first of all, I think it's important to talk through the timeline here because the timeline keeps extending further out. The The CFPB originally announced an advance notice of proposed rulemaking back in 2012, and the intent back then was to ask questions about general purpose reloadable cards, the cards that consumers typically use as checking account substitutes. And they asked questions about whether or not, or how they should be regulated. There were several specific questions they asked. And then you roll forward 2 years later, and they came out with the notice of proposed rulemaking, which really surprised the industry because it greatly expanded the scope of the rule beyond general purpose reloadable cards to all prepaid accounts with certain exceptions. And we'll talk through that in a little more detail in a few minutes. And mind you, this is an hour and a half long presentation. I'm going to try and give you about 10 minutes. So let me whip through it quickly and stop me if you have questions. So the rule, the comment period for the rule ended May 23rd, 2015. March 23rd, 2015. We expected the rule to be out by the end of the year. It didn't happen. I think they then predicted that it would be out in January. And then in the fall rulemaking forecast, it came out that it was going to be out in spring of 2016. And regulations.gov, I believe at that point in time, said March 2016. I think they just picked the first month of spring. Director Cordray on several occasions said spring's, a long period of time, and it ends in June 21st. And in fact, I think he mentioned in one of his semi-annual hearings. And they've now just recently, in the spring rulemaking agenda, extended it out to summer of 2016.
Don't you think that's a good sign, though, that maybe they're considering the substance of the rules, or do you think that's a bad sign?
I think sort of a mixed bag. I think it's a good sign that they're taking into account the comments they've received. I know that we've met with them 4 times since the rulemaking period ended, and each meeting lasted 90 minutes to 2 hours to get really in depth on specific topics. But the longer they delay it now, I think it's hampering innovation, and everyone's just waiting to see what's going to happen. There are several material changes that flow through the rule. Some that I think will be useful and helpful, some that might be over the top, and potentially, if they don't fix a few things, might pull some products from the market. So I think everyone's eagerly awaiting the final rule, and we're ready for it to be here.
Right. So can you, we talked a little bit ahead of time about, a bunch of consumer protection provisions that, probably the industry could live with, and then other provisions that would actually make maintaining a prepaid program more onerous and potentially more costly than a DDA. So maybe you can kind of start with what's good and then what you think really needs to be changed.
Yeah, it might be easier just to go through the rule, and we can talk about the pros and cons of each piece, and I'll go through it as quick as I can. First thing is scope of prepaid account. It's defined as really anything that's prepaid that follows a 3-pronged test. If it allows purchases of multiple unaffiliated merchants, or 2 ATM transactions, or 3 P2P or P2B transactions. So for their very first time, they're looking to regulate products and services like PayPal under the requirements of the rule. And what the rule does at a higher level, it takes regulation need that currently today regulates payroll cards and non-needs tested government benefit cards, and expands it to that broad category of prepaid accounts. Now, there are certain exceptions to the definition, which include things like HSA, FSA cards, debit cards that are attached to consumer asset accounts that are already defined as an account under Reg E, which is an interesting, creates some interesting issues. Also excludes gift cards that are defined under the Card Act, and loyalty award and promotional cards. So to hit the one interesting item that we talked about earlier is the exclusion of consumer asset accounts already regulated under Reg E. Those are things where the lines get blurry, are things like checklist checking accounts, like a GoBank account. I think they've defined it and followed the rules that would apply to checking accounts, including paper statements and other requirements. But if you think about some of the other products that are sort of in the middle there that could be introduced or are in the market today, you've got to decide whether or not you fall into the prepaid bucket or the consumer asset account bucket already defined under Reg E, because some of the differences are paper statements versus electronic statements for prepaid accounts, and overdraft. There's separate overdraft requirements For checking accounts, where there's an opt-in requirement and not as many restrictions as you now find under the proposed rule for prepaid accounts. If it's a prepaid account under the proposed rules, you fall under Reg Z rather than Reg E for overdraft. And overdraft, because I know it's a big topic, you break it into two pieces. One is intentional overdraft, and the other piece is forced pay transactions or unintentional overdraft. So intentional overdraft, there's certain programs in the market attached to both payroll cards and GPR cards, or general purpose reloadable cards, that allow consumers to overdraft. Typically, it's limited to $100. Sometimes it's $150, and then it's typically repaid with the next deposit to the account. And then forced pay transactions are accounts that go negative because of just the normal operation of the network rules. For example, you pay at the pump and you have a pre-authorization for $1. If the settlement comes through at the end of the day for $75 and you only had $60 in your account, it's going to naturally cause that account to go negative. Now, it's not a feature that you've offered, that you're charging a fee for, it's just a natural occurrence that happens with the product. Similar issue would occur with restaurant transactions where you give a 40% tip and they've pre-authored or authorized a 20% tip, and if that exceeds the balance in your account, it will cause it to go negative. I think the Bureau thought that the forced pay transactions are something that rarely occur, and issuers would just eat the cost and write off the difference. I think after the rule came out, they realized that this was the most complained about provision in the rules. And so I think we got to the point where we were going to meetings to talk to them about it. And the first thing out of their mouth is, all right, well, we're not going to talk about forced pay. We get it. We know it's a problem. We didn't know before we get it. So let's not talk about that. Let's focus on the other pieces. But for overdraft, what the requirement of the rule, and you go through 2/3 of the rule, it talks about treating similar products the same. So if someone's got a general purpose reloadable card, they're going to expect to get the same protections as a debit card attached to their checking account. So that's the theory throughout the proposed rule. And when you get through 70-80% of it, treat similar products the same, give the same protections as a debit card attached to a checking account. And then you get to overdraft and they say, well, wait a minute, that's not good enough. We need to add some additional requirements. We want you to comply with Reg Z now for any overdraft features that are on the account. And we also want to make it even worse for you. Not only do you have to comply with Reg Z, but we also want to require a 30-day waiting period, because we don't think consumers are smart enough to think for themselves. So you've got to give them 30 days after they acquire the card to think about whether or not they really want overdraft, even those that bought the card specifically to receive overdraft. So the difference under Reg Z, let me pull out my trusty list here, because there's several requirements under Reg Z, but one of the biggest ones is paper statements. So that's one of the big cost savings for prepaid cards in the market today is you have the ability to provide electronic statements, typically over the web, online, and many programs in the market will allow text message updates to give you balances and histories of or confirm when transactions take place. But once you're under Reg Z, the first thing you have to do is conduct an ability to repay analysis. Now think about that. You're extending credit for $100 or $150, and you're going to go do a credit check on someone? I mean, it's similar to some of the requirements under the payday loan rules that came out earlier this week or last week, I guess it was. So I don't think that's going to happen for a $100 overdraft. You can absorb those costs in the program and still profitably operate that kind of a program. When you add that on top of the written statement requirements, there's concern that product might not be around after the final rule if it doesn't change. We had lengthy conversations with them about that. Our suggestion was keep it under Reg E and put common sense guardrails around the product, like you see in the products in the market today. Things like if you overdraft the account and pay it back within 24 hours, you're not assessed a charge. If the overdraft is less than $10, to avoid the $35 pack of gum example, if it's less than $10, you're not assessed a charge. And many products in the market also limit the number of overdraft charges you can have in a month to 2 or 3 overdraft charges in a month, and then you stop being charged for overdraft. So we're hopeful that they change those provisions in the final rule and keep it under Reg E. I think one other possible alternative is we know that there's a checking account overdraft rulemaking that's coming out sometime this year. I'm sure as everything else gets pushed back, it might be late in the year or early next year, but We're also hopeful that they might just punt on this issue when they publish the final prepaid account rule and handle overdraft with the checking account overdraft rule, since we're trying to handle similar products the same.
Okay, so I think, what we had talked about, two very clearly onerous potential provisions, one about applying Reg Z to prepaid cards, the other about requiring statementing, paper statementing, which would drive up costs. Before we kind of turn to practical examples between Barry and Alex, is there anything else that you would add that you think was going to have an unintended negative consequence?
Well, I could probably go on for 2 hours. Let me give you real quickly the other requirements of the rule, just so we have it. So we've got broad scope of prepaid account. You also have disclosure requirements. There's both short form disclosure and long form disclosure requirements. Long form, you've got to provide all the fees possible, and you're supposed to provide a pre-acquisition, which we can talk about a little bit more. And then there's a short form disclosure, which must appear on the packaging. Very specific requirements where things are. There's 7 static fees that have to be reported. There's incidence-based fees that have to be updated every 12 months based on what are the most commonly charged fees other than the static 7. And then the long form, the Bureau's own studies say that consumers don't really read it, they don't understand it, they can't really compare 2 products, and the fees that they think are most important are already contained in the short form disclosure, so you scratch your head and wonder why they even included the long form disclosure requirement. There's also limitation of liability and error resolution rights, which you have today under Reg E. So if there's an unauthorized transaction, you essentially, you could have a debit card today and have your PIN number written on the back of your card on a Post-it note and lose your wallet and someone stole all the money out of your account. That's an unauthorized transaction, even though you're grossly negligent in that example. And you could, under Reg E, get reimbursed all the money that was spent. Those requirements or obligations for issuers to reimburse consumers are going to apply to all prepaid accounts that fall under the rule. Let me see if there's any other big picture things. Transaction history requirements. We're going from the existing requirement of 60 days transaction history to 18 months. So it's a big, massive jump in the amount of data you've got to keep. And then also there's requirements about how that data has to be displayed, which is quite different. Today it's a rolling transaction history, so if you've got a purchase and then a deposit and then a fee, it just appears sequentially. The new requirements, you have to treat it similar to a bank account. You've got to bucketize fees on a monthly and annual basis, and there's a lot of other specific requirements. Not a big deal at a macro level, but if you've got to recode the way these processing platforms work, it's going to take a significant amount of time to get that implemented so that you can report the data in the way that it's now being required. And then the last big picture issue is the effective date. The proposed rule had a 9-month effective date, and most of the folks in the industry have asked for 18 to 24 months to implement all these significant requirements. So that's the high level, and we can dig in wherever you want.
Great, thank you. So let's do this. Let's turn a little bit to the practical application, because we wanted to make sure that we had some practitioners up here. So I'm going to ask both Barry and Alex to first just describe what their business proposition is today, and then we're going to go back and talk a little bit about how they are, think that both they and others will adjust. So Alex, do you want to just quickly describe your business, what it is, who it's targeted at, and then I'll ask Barry to do the same.
Absolutely. And thanks, Brad, for a clear explanation of the rules. A lot harder to read 400 pages. Barry can probably speak more authoritatively to kind of the existing and traditional prepaid industry. Our perspective is that of a young company and that of an innovator. And what we do fundamentally is we offer low-cost replacements for a checking account on prepaid rails to low and middle-income customers, primarily here in New York and now in San Francisco, where the customers don't necessarily, we disclose to them that there's a difference, that it is in fact a prepaid account, but from a functionality perspective, customers can think of us almost like a checking account because the functions become very close to strictly equivalent, and in some cases superior from the customer perspective. Say, we do not offer overdraft, which for certain customers is absolutely superior to accounts where they have to opt out and might not understand that they have to opt out before they get it with a surprise overdraft. So we, having been in business for approximately a year, we are built to be a customer-friendly account. And so what we've done largely sits in compliance, we believe, with the proposed rule kind of from the beginning. So we're a little bit blessed in that we don't have a huge amount of kind of industry-driven enhancements we need to make to our platform in order to support compliance with the proposed rule as is. Now, that said, I think, from our perspective, we look at what would a startup in our shoes starting today have to face if they were trying to get a product like ours to market. And the barrier to entry is significantly lifted by, I believe, by the proposed rule. Insofar as it extends, I think it's likely to extend the degree of scrutiny to third parties trying to launch products in market, likely to forestall different types of innovations that have historically happened on a prepaid platform because non-bank entities can innovate on a platform. And I think it's, both of those are, if I look back at our history, I think important factors that we were able to get through but were not given, and that process will be substantially harder for new entities trying to enter, particularly if they're truly entering as a de novo startup without substantial capital backing, like a major retail chain or what have you.
So before I go to Barry, can you just give the folks in the audience just a little bit more of an idea about how you acquire customers, maybe about how large you are, and anything else in terms of your platform or functionality that you think is unique?
Sure. So we are, in some ways, ultimately retail innovators. What we do is we acquire customers face-to-face. So we don't use any of kind of the three traditional prepaid customer acquisition methods. We don't use third-party retail. We don't acquire customers online directly today. And we don't partner with payroll organizations or other organizations with substantial disbursement needs. What we do instead is we run, they're not branches, but we run teams of product experts who enroll customers face-to-face in their neighborhoods, primarily in dense areas, community events, and other sorts of non-traditional environments where a large congregation of our customers might be, but people who ultimately need the additional face-to-face conversation to build the trust necessary to switch from a check casher or whatever traditional financial product they use, whether it's something offered by a bank or more commonly something that's not offered by a bank, that's offered by a non-bank financial institution. So we offer to them is an extremely low cost, arguably too low cost product, certainly lower than any of the restrictions you see in the rule today, to those customers with a pretty straightforward value proposition that will save them hundreds of dollars a year, whether or not they're on a traditional checking account today because they get hit by overdraft monthly minimum fees, or if they're on using some combination of check casher or one of the more higher cost prepaid cards out there because we are substantially lower cost.
Okay, and we'll come back to the P&L in a little bit, but Barry, can you tell us about your business, how you acquire customers, and anything that in particular is unique that you offer your customers as they go to market?
Sure. Hopefully everybody can hear me. So at Praxel, we have traditionally served as an enabling program manager. When I say that, what I mean is we don't create a product in a box that we're out there, trying to find consumers for. We have really like a processor. We have a processing relationship through FIS, but we control all the middleware and the experience, the websites, the call centers, and all those kind of things that you interact with, the mobile app, and we really create an experience and change the pricing and everything about the way that product operates, the way it engages the consumer, specific to what our client requests. So we have clients in the tax industry, we have clients in the check cashing industry. We support an inmate release card program for people getting out of jails. We have all kinds of programs because people have all kinds of needs for a GPR product. And that makes it very challenging. So not only are we supporting multiple ways of interacting with consumers, we're supporting multiple brands. So everything has to be very fluid and in what we do. In addition to that, within the past year, we've also kind of turned our equation on its head and also are creating a means of kind of creating product sets that can enable really targeted to small, medium businesses who might want a payroll alternative, a pay card alternative. We call a payout GPR card, or a reward card, or a commercial type card or an expense card, in a way that they can customize and put their brand on it, but quickly be able to get a card without having the scale that's usually required for for you to get a program to market and be able to launch a product. So that's what we're all about.
So can you tell me and tell the audience a little bit about, we talked before that, the pricing may be different your pricing, I know, is published online, but can you talk a little bit, what do you, if the CFPB rules regarding pricing, minimum prices, et cetera, come through, what's going to happen to the base of your programs? What kind of changes do they need to make? What do you think that's going to do to profitability? How are you going to manage that impact?
Sure. Being in the prepaid business in the GPR space is a very small margin business. I've been doing this since 2003, and the intent was always to create an alternative to a checking account. It was supposed to be a checking account that was more accessible. You could load it more places, you could do more things with it, and the government keeps trying to differentiate you from a checking account. But that said, as these costs to provide our services increase, obviously we have to, and we don't control the retail costs because that's on our client side in that model of our business. It just means that either our wholesale costs go up and they need to absorb more of that and have more distribution to be able to do so, or we also have a model whereby we share a percentage of what we call GBV, or the loads on the cards, and again we have different models because obviously if there are different monthly fees on the card, or different price points on the card, consumer fees on the card, that's going to change the amount of revenues generated from the card. But we'll continue to, we think that's probably our best model and our simplest model, and we'll just have to relook at that with every assessment pressures from the market pressures to bring the consumer pricing down, and our pressures from our providers and vendors that bring our costs up.
Right. And can you, specifically with regard to overdraft, can you dimension, by cards or by number of programs, or in some way, what percentage of your programs actually have overdraft capabilities now, and how would you actually, if you were required to apply the rule as it is today, how would you deal with that? How would you accommodate it?
I actually had an overdraft card in 2001. And back then, when there were no rules, it was a great product to have. But we really don't offer a overdraft product today. Our issuing banks don't permit that. But I think that one of the values of obviously clarity that regulation provides and setting what the rules of engagement are, that will free our bank to perhaps, and other banks were speaking to other issuing banks who will have an appetite to be in that space, because again, if you're in a small margin business, you need to complement it with other value points and other revenue elements.
And just real quick on the overdraft piece, if you went back 5 or 6 years, there were probably 5 or 6 different banks that allowed overdraft, and there were a couple enforcement actions in the industry that the temperature, I think, for the prudential financial regulators changed overnight. So a product that they thought was fair to consumers for 2 or 3 audit cycles in a row, all of a sudden was an unfair, deceptive product with no change in the product features, exactly what was previously approved. And because of those enforcement actions, there were a couple of them that came out of left field. Most banks stopped offering them. Although one of the banks that was subject to one of those enforcement actions actually is one of the few that still offers a product today. So I think if there's clear rules of the road in the final rule, and it doesn't fall under Reg Z, they do something else with it so that you can actually offer a profitable program, I think you're going to see a lot more issuers get into that, or get into offering that feature and functionality.
And I just wanted to add that obviously prepaid found tremendous growth and acceptance through the underserved communities, and that's great. And yet it's it's on our back it's something that we have to work through, because as it becomes more and more a viable product for middle America, whatever you want to call them, then the regulators are looking at us and putting all these controls in place because they see our audience, and maybe as we broaden our audience and they take note of that, then we can be treated more like a checking account.
But do you mean that they feel this particular need to protect your audience? What do you mean when they say?
Again, it's an underserved market that is a large part of the market we serve, and so therefore the perception is that we have to protect against predatory practices.
Okay. Tom, do you have a particular view? Is this, because I think the overdraft one is interesting. In one hand, it creates confusion, but if a lot of the banks aren't doing it and the regulation would actually give clarity, maybe it's a good thing. But right now, do you have clients that are concerned about these rules, or do you think they're just adopting wait and see? And is there any particular, angle or concern? Is it overdraft? Is it the statementing that concerns them, or is it, people are waiting to see what the CFPB comes up with?
Well, from the perspective of my desk, I think it would be improper for me to talk about some of the concerns that have surfaced. But in broad strokes, I think what's really interesting about this development is the way that the Bureau has approached the proposal to regulate a prepaid account and not take into account the relationship between a checking account linked to a debit card is surprising from my perspective, because it's similar to the way that the board incrementally adopted rules under the Electronic Fund Transfer Act to suit particular products. And we have currently in Regulation E a particular set of regulations or a particular set of requirements that apply to a payroll card. And now this rule would apply to a prepaid account. But the functional similarity to a checking account is plain for many of us to see. And the substitute effect is one reason why the Bureau perceives a need for regulation, why members of Congress perceive a need for regulation, why consumer advocates perceive a need for regulation, because there's millions of consumers who, for all sorts of reasons, do not hold demand deposit accounts, which might have a functionality of a debit card, use a prepaid card. And yet the proposal is ambiguous as to how for an insured depository institution to offer an account that might actually be a prepaid account, but for the peculiar exemption, right, in the definition.
Yeah.
I think this is an odd quirk of the Bureau's proposal, because the landscape in front of this marketplace really is occupied by bank and non-bank providers, right? And so everyone could understand that a little bit better. One of the integral developments in this area of financial products was the innovation from the Federal Deposit Insurance Corporation. It clarified that yes, when a company is accepting funds for a general purpose reloadable card and places those funds in an insured depository institution, there is a way under the FDIC's existing rules to provide for deposit insurance for that cardholder. Right? That was an important development that allowed.
Was that a while ago?
Yes, that was about a decade ago.
2008, I think.
So 2008, essentially it said to a prepaid card holder that they had FDIC insurance.
Right.
It's
Correct.
pass-through insurance to the maximum insurable limit for each cardholder.
Right.
Even though it's money's held in an omnibus prepaid account, as long as it's titled as a custodial or trust account, and you're calculating the exact balance for each cardholder, which is the business you're in. I mean, that's what the processor does. Then you have the ability to offer pass-through insurance to the individual cardholder.
And so to get to your question, what do clients think about this? From my perspective, one of the interesting developments for the Bureau's proposal is that the Bureau, under the Consumer Financial Protection Act, has broad authorities to regulate an entire market segment between an insured depository institution, credit union, a non-bank financial provider, or a bank holding company that might have different companies within the same company that can lay off certain risks or take on different products due to its operation efficiencies, et cetera. And still, as if we're back to 2001, we get a rule that's here's a prepaid account. It's a really interesting way to proceed.
So was that suggesting that this rule that you just cited differs from rules that have been made subsequently? It kind of steps back or it differentiates from something that had been assumed?
No, what I'm suggesting, and perhaps I can speak more plainly for myself, is that when the Bureau is proposing a scheme of disclosures relating to cost of a product,
Yeah.
what Brad was talking about in terms of the requirement that would be imposed on a provider of a prepaid account to issue a short form and a long form, if I were to be a bank, I would ask myself, well, is next year the year I'm going to have to offer, I'm the product salesman here speaking, a short form and a long form for a checking account or for a savings account? So that an ordinary consumer, when comparing the costs of an account, would have to see what's the minimum balance that needs to be retained, what are the implied costs of having that minimum balance vis-a-vis the trade-off on insurance, et cetera.
So suggesting more disclosures, or the rule would require more disclosures for a prepaid account than a checking account to which they'd often then compare.
Right, and I think, right, that's one of the things that we talked about is you have what's intended to be kind of a simple, theoretically no-frills product, but, things get more complicated. And in fact, go
I
ahead.
would just add that I think that what needs to be taken into account is the level of engagement and opportunity that people have. When they're buying a prepaid card in a retail environment, maybe they didn't even think about it and they're just buying it off the shelf.
Right, exactly.
But whereas they're at the bank, there's someone to talk to perhaps about it. But there's always the internet now. No one seems to take that into account either. There's so much ways to get information these days that I think it's right to take into account the different experiences and to provide disclosures and appropriate disclosures and availability of disclosures. So, I bought things that I thought about after the fact, crap, I could have got it cheaper somewhere else. And maybe I throw out what I bought or return it or whatever I do. We all,
And to later on there, just real briefly, I myself am shocked that the short form disclosure and the long form disclosure subordinates the consumer's right to recover funds and value when the consumer complies with the protocol for contacting the bank about the lost access device. To me, that's like cost. What about the $500 I just lost? If the consumer doesn't see that and sees only that the cost of this product is $4,
it can be confusing. It's overwhelming.
Exactly. It's overwhelming.
And particularly if you're maybe uneducated or not experienced in the financial world, those things are lost.
So, I don't know, did you have a question for you? Go
I
ahead.
just wanted to ask a question on kind of echo what Barry is saying there. The Bureau seems to come across that consumers are ignorant, or maybe the
if I may speak to that,
Well, let me just
Go ahead.
1 second. Where I'm going with this is, has the Bureau ever looked at the concept of educating and verifying people ahead of time and having some concept of verification, educating them to be approved to have one of these products? Has that concept ever been discussed?
Who would that fall on?
Well, there's an
Driver's
example.
license, you could
There's
have
an
a.
example of an education program that's offered with the Treasury's Direct Express card, and they teamed up with a company to do that. And what I found interesting about it is that the education is really more tied to what the issuing bank wants them to know of how to use the card to generate more interchange. So it's more value to the bank. And and likewise, when it comes to government, I don't want to veer too far off here, but when it comes to the government benefit cards, that is a great way to distribute, money and efficiently and inexpensively. But now you've locked people into a product that is not a mainstream product. And where do you use that vehicle, or where do you educate the consumer to say, okay, I gave you this access card, but there are other opportunities, and not kind of try to drive them into and lock them into a card that doesn't really put them in the banking stream.
One other thing I would add that's interesting when you look at disclosures and the ridiculous amount of disclosures I think that you have under the prepaid account rule with the short form, the long form that are both have to be delivered pre-acquisition. You also get all the fees disclosed in the terms and conditions that accompany the card. And if it's a payroll card, there's specific disclosures under state laws in many states. So you're literally getting 4 disclosures worded differently that have to have very specific requirements that I think are going to confuse the heck out of consumers. And then you look at the CFPB's proposed arbitration rule, which essentially says consumers are stupid and they don't read disclosures, so we need to protect them because even though you've been disclosing the arbitration agreement all along, they're not smart enough to read it. So we need to get rid of the class action waivers and arbitration agreements. So it's the exact opposite argument.
They're going to keep doing this and doing this and doing this until they get to the point where they come up with a verification process to say, you as a consumer do understand this. And then you can, I'm telling you, that's where it's headed. That's really good.
Other than that
Financial
checkbox, you mean, the
product
checkboxes as I read and understand? That we all just click?
Did you have a question, Kay, or?
I was going to say, which form, which disclosure? When you say consumers stupid, I think consumers are overwhelmed. I mean, I'll take a personal example. To convert my business checking account to electronic only, to take it away from paper, there is an 18-page agreement. Now, I'm choosing to take, although I don't use them, I use electronics. I keep my paper thing just so I don't have to sign an unread 18-page agreement or spend $500 or $600 of my time trying to decipher it and trying to remember what was where on the scroll. Is anybody use testing these things on consumers, doing focus groups on understanding at various levels? And I have one other thing when you talk about consumers. Look at who the most popular general speaker is. He speaks at a 4th grade level, which is what people seem to respond to. And if you look what they have, look at what the average, what they say the average American reads at, there is a level. I mean, I would say, except here, and we're with a lot of lawyers and stuff.
Prepaid is the only industry where you go to an ATM machine and you have to punch checking account. Right. You go to a store and you have to get credit.
Right. Doesn't make sense. Do you have a question here or comment?
I do, actually.
Yeah.
I just want to make sure I understood the previous debate, and I think I do, but I just want to try this on the panel and make sure I understood it properly. The Consumer Financial Protection Bureau is imposing quite a bit of regulation on the industry at large, right? There are a lot of these disclosure agreements, but their fundamental premise seems to be that consumers are uninformed, uneducated, and have difficulty understanding the agreements. Is it truly that simple? Like the obligations to disclose get more and more exhaustive, while at the same time the burden on the consumer gets to be less and less?
I disagree with that strongly. And I think there are many laudatory things in the CFPB's action, both with regards to prepaid and its broad push towards clear disclosure across a variety of financial products. At the end of the day, there's a fundamental tension in any sort of legal agreement, in any sort of product that you purchase, between the clarity of disclosure and ease of understandability and the relative complexity of the product. And so I think the evidence suggests, both from behavioral economics and from the CFPB's own studies, that people have difficulty understanding the agreements that govern their financial accounts, as do we all. And I'm not a lawyer, but as a reasonably highly educated person, it is difficult for me to understand the contracts that I enter into on a day-to-day basis with a credit card provider or what have you. And so I think it's important to realize there is absolutely a role for, I think, what's the laudatory goal of the short-form fee disclosure. I'm going to talk about the long-form one right now, which is to say that there may be certain easy-to-present standardized information pertaining to a certain account type, leaving aside the account type definition question that Tom brought up correctly, where you can say, like products should have a standardized thing that's easy to understand and that demonstrates the key features and functionality as well as the key costs of the product. I don't think that you presume because someone wants to provide such a disclosure to a consumer that the consumer is necessarily uneducated or unable to understand. I think all you have to do is realistically expect what all consumers at all levels of the income stream absolutely do. They just don't have a private banker to come explain it to them.
So I think I would disagree with that, actually. That I agree with you that I think the short form disclosure for prepaid products will be extremely helpful so consumers can compare. But if you read through the whole 870-page rule and read between the lines, yeah, there is an undertone about consumers not understanding anything. And the long form, just real quickly, I'll read you a quote from from the rule itself, and this is a CFPB quote. It says, and this is with respect to the long form, not the short form. It says the Bureau does not believe consumers would necessarily benefit from receiving only this long form disclosure before acquiring a prepaid account. In the Bureau's testing, for example, many participants reported feeling overwhelmed by the amount of information included on the prototype long form, and they struggled to compare two long form disclosures, even those that listed identical fee types. So I think our issue is way too much disclosure with the multiple disclosures consumers are going to get. But I completely agree with the short form that if there's a simple way for consumers to compare products prior to purchase, I think the industry is completely in agreement with that approach.
And Brett, I actually think that I agree with you. I think the long form goes slightly too far, but the principle that they're saying, the principle which I think is being, it's very hard for a regulator to reject a seemingly good idea. And I think the long form and short form together represent two seemingly good ideas that are a bit redundant.
Okay. So let's start first in the back. Go ahead, and I'll come to you.
The attention span is very, very short. Why can't you just do point A, point B, point C, point D, and finish? Why does it have to get into long form, short forms, and all this thing? Nobody reads it. Nobody reads it. I mean, I'm in the processing business. Nobody reads a merchant processing agreement. Zero. The smartest person in the world doesn't do it. And it just basically, it's like just putting more and more on these people to get over on them.
For me, I was just going to say, I mean, disclosure is just one of many, and the cost of complying with the disclosure is just one of many areas where the cost and incurred in meeting these requirements, whether it's the overdraft or the disclosure side of things or whatever it is, increase the cost and inhibit innovation and your ability to bring innovation to these products. So you create a barrier to entry. It's hard enough to deal with the fraud and the risk and the compliance and build scale and handle distribution and marketing of these products. Then you then have to, on top of that, try to compete with the NetSpends and Green Dots of the world. So what are you doing? You're blocking, any kind of innovation out into this space.
And I think even though, to your point, even the largest players, banks, program providers are complaining about the compliance burden. So how do smaller companies deal with it? And I think the net effect is, unfortunately, to your point, a year later, who's going to enter the field, et cetera. You had a comment or a question
actually,
here.
I'll pick up on Barry's point, and I'm an entrepreneur, but also a rare. So I believe the government should protect certain classes of people. So, but it's unintended consequences. So I agree with you that all this regulation hurts innovation and it costs the little guy money. But what I'm curious to get your opinion on is, on the other hand, what also hurts innovation is that the banks in this industry are all in paralysis because they're afraid of all the risk and the unknown and what's going to happen. So is there any silver lining in terms of the regulation or clarity that you think will free up banks, whether it's overdraft or savings or other things that they've tried in the past and got slapped down for?
Yeah, I can speak to that. I think my feeling about it is that a lot of the consolidation in the GPR space is because the rules were so vague and we're all kind of pretty captive, and so those even the startup programs that were doing well and gotten a lot of bandwidth, the account now, the cheap cards, whatever they may be, found themselves where they couldn't innovate anymore, and the banks weren't allowing them to grow, to increase distribution. So what are you going to do? You might as well sell out and maybe get some stock in the company who can compete in the long run. So having the regulation passed, I mean, it's comforting to hear Brad say that they understood the forced post. So okay, that'll hopefully change, and hopefully they'll hear other things. But I keep and continue to have a problem with the distinctions between the core of the functionality, the checking account, general check account, DDA account will provide, and what we as a prepaid provider can provide. Why should there be different? There's a lot of advantages that people, have in wanting to load cards everywhere. Why do I have to go to my bank branch and load? Obviously I can use my cell phone now, but why couldn't I also go to retail environments and all those things? I mean, to me...
I think it's important to remember why the product started in the first place years and years ago, or one of the primary functions is ease of distribution. You can get a prepaid card anywhere nowadays. You can go walk a block in any direction here and get a prepaid card. And you hear about the sort of the bank deserts, places in New York City, in fact, where you could walk for miles and not find a bank branch. So it's ease of distribution, and it's also the ability to have a financial vehicle that you can use to manage your entire financial life when you can't get a bank account because of the check systems and other databases. If you pass a couple bad checks, you can't get a checking account. So that was the whole genesis of how this product started when you go back 10 years
And I'll
ago.
just say that I know products that are still overpriced and continue to get distribution because they have a niche. And they have a niche for that distribution, and people, for whatever reason, I don't know why they buy that product, but they do. And all the disclosures in the world are not going to change the fact that they'll continue to buy that product and not switch off that product. So, in this space, it's all been about the growth. It's been about people who have niches in distribution. If it's Green Dot having, the C-store world, or if it's Netspend taking advantage of the alternative financial service providers in their early days. If it's H&R Block because they're issuing, 3 billion tax returns every year. They have 3 billion opportunities to give a prepaid card every year. Now try to get them to keep using it.
Right. So let's see if there are any more questions from the audience, and then after that we'll close. I'm going to ask each of you to kind of give any final words and any final predictions about what you think will happen. But any other questions? Let's go here first.
I'm just curious, if a consumer messes up a prepaid card for whatever reason or way, and the disclosures are provided to the consumer, is the purpose, going on the assumption that people don't read, and I'm sure all of us have checked the box on the bottom of a really long scroll down. I have read the terms and conditions. Like, are you crazy? So the question I have is, what is the purpose of the disclosures? Are they for consumers to compare products? Are they to protect the issuer when the consumer has a problem? Or are they, I don't know, what is the purpose?
The primary purpose is to allow consumers to compare disclosures, which is also the reason that the Bureau is requiring the posting of cardholder agreements online, which is another thing we didn't get much into that doesn't make a lot of sense for certain products like payroll cards. We can load all the payroll cards in the world that are out in the market, but that doesn't give the consumer the ability to choose any of those payroll cards. Typically payroll cards are sold by a program manager or issuer directly to an employer, and so they have that one choice. I mean, if you have a bank account, we'll direct deposit to your account, or we'll deposit to your payroll card, and this is the one we're going to offer to our employees.
So does the
PB.
have they done research to find out what, if any, comparison shopping consumers do?
I think they have there's an account agreement study. I don't have a copy. I've got a lot of other documents here. I don't have that with me, but they did analyze the market, which is why it's so remarkable that they still have the long form disclosure requirement in the rule. I think the consumer groups are pushing hard for that. But at the end of the day, that they've determined that it's not very helpful. I think the information is useful to have. I think that all of the fees should be disclosed. And I think many in the industry would be in agreement that if it were disclosed online so that a consumer can access it whenever they wanted to. That's the way consumers shop nowadays. I mean, you think about it, your experience at Best Buy, you go into Best Buy, you look at a product, you want to see it, touch it, feel it, and then you go right to your phone and decide whether or not it's cheaper somewhere else. And that's why Best Buy is, matching prices, and their whole business model's changed. But I think it should be the same way with a card, that you have the ability to compare the products. I think a short form disclosure, although we have some issues with some of the requirements in the disclosure, I think it's a great idea to be able to compare products. And then I think the information and all the fees need to be available so consumers can look it up on the web, for example.
So these consumers who will walk in 2 blocks in any direction from this building and pick up a prepaid card, they're not comparing. And I sort of doubt they've done research ahead of time.
Well, I would say that they are comparing in a different way. They may not be comparing and hiring a lawyer or taking the 2 disclosures. They're talking to their friends, talking to their cousins. They're using the card. They're looking at what they charged them. They're seeing if that makes sense to them or they feel ripped off. And that's the way we compare things. And, and I think in my view of these contracts of adhesion, they sit there and they work their way through class action lawsuits and the litigators and the consumer groups trying to hopefully define what the rights and obligations should be, really of parties in this type of relationship and this type of product. And, I'm just going to throw out there that maybe the CFPB should say, here's what we decided the perfect contract should look like, and everyone uses it. And now let's get to compare the products, and are they good and bad, or the price.
Well, I think that's a really important point, though. At the end of the day, if you buy a GPR card at retail and you decide you don't like it, you're out $5. You go buy a different one. And I just did it myself 2 weeks ago. My daughter turned 16. I wanted to get her prepaid card so she could buy gas. And brought it home and went to register it, and they wouldn't allow it to be registered to anyone under 18 years of age. So I didn't want a card in my name, so I told her to spend it down and we'll find another product. But again, what did it cost me? It cost me $5, and I'm gonna go buy another prepaid card from another one of our members. And
We have a couple of questions here. I'll come to you. Let me just get one for everybody. Is it Adam, I think?
Adam, yeah. It sounds like there's consensus among many of us in the room and on the panel that mandated disclosures are not the ideal scenario. There's plenty of scholarship on this topic. Omri Ben-Shahar has written a book called The Failure of Mandated Disclosure. What's the next iteration? We have technology at our disposal. What are your companies, and what are the companies that you all are counseling and dealing with, what are they doing to think about a better alternative? If government required written disclosures are not effective, how do you inform consumers at the time of purchase or beforehand and arm them with the information they need to make a good decision?
So what do you do instead?
I mean, isn't the short form enough for them to make those distinctions? I mean,
Well, again, I think we would all say that probably so, but we're not the CFPB, and we probably don't know what they're thinking and why they think.
And unfortunately, I don't think the industry is going to innovate at all in that regard, because we're going to have requirements that are imposed on us, and everyone's sort of a paralysis mode waiting to see what those are.
But I think that's in every product. I mean, every product you go to today and you go online, you click that button, you haven't read a damn thing that said, and you just move on until a problem happens. And maybe you go, well, what did that agreement say? There's terms of use in websites. No one reads any of those things, but they're there. So when there's a problem, we know what the rules were supposed to have been.
Was there another question here? We'll go back.
I want to change the topic to loans or lines of credit. So if I understand reading the rules, they're saying that if I have a prepaid card program, and I'm a program manager, and I want to provide a ACH credit to that card account, as long as it's not connected to that card program and it's sourced third party, that's okay.
You're getting kind of deep in the weeds here.
That's questionable.
But yeah, it's not entirely clear. The language was not clear. We actually talked to the Bureau about it. And their view of it is if it's completely disconnected, there isn't a revenue share going back and forth, and they're two independent separate companies, then it wouldn't be considered an overdraft. And the issue is, if you go out and get a payday loan and the payday lender requires it to be deposited on their prepaid account, then it falls under the Reg Z requirements. If it's disconnected, and the argument that some of our issuers made is, we don't know where that deposit's coming from. How can I regulate that when you've changed the nature of my product from a prepaid card to a credit card under Reg Z without my knowledge, and I didn't want it to happen, and I didn't know that it happened to me. And so they said that's not the intent of the language in the rule, and there has to be a direct correlation, either a business relationship or revenue or money changing hands or affiliated company, then it would fall under Reg Z. Otherwise, it's not supposed to.
But to that point, when I get a mortgage at a bank and they say the rate will be lower if I open up a checking account, and they'll debit the checking account for my monthly payment.
But you fall under Reg Z.
But I don't get a credit card statement and all that stuff from them. I get my mortgage payment, and it comes out of my checking account. So how is that any different if it came out of my prepaid account, which I'm using like a checking account?
Yeah, I mean,
I'm
I think
sure
that
you had 20 pages of disclosure as well.
I think that gets to a critical point, which I think Tom hit again in the beginning, which is there's a real issue with like-to-like comparisons throughout the rule. And you can see that whether, kind of across the provisions, and many of the ones that I would argue are Most consumer-friendly could easily be extendable to checking accounts or already are in place for checking accounts. When you think about error resolution, for instance, being mandated for GPR cards post-registration. But you always have to be questioned. I always have a question when you see it's a like-to-like product and you see disparate treatment of different products based on presumed customer base or presumed channel. And I think that doesn't really apply. There are a wide variety of different types of products that are built on prepaid platforms, including many of the most innovative financial technology companies in this country, some of whom do use a traditional prepaid model, like when they're using a third-party retail, though fewer of those recently given consolidation and lack of innovation. But many people who are offering a variety of different types of accounts on the same platform, and you risk tarring everybody with the same brush and also setting the bar higher than you would set for a checking account provider for a Bank of America. Bank of America, perfectly happy to cross-sell you a credit card if you're opening a checking account. Their business model is predicated on it. Debit businesses historically have always been break-even or loss-making businesses at major banks that relied on cross-sell and relationship building to drive their economics. You're already talking about taking an industry where the primary economic driver is debit for customers who, by and large, are hard to serve, although I think that's, again, a generalization about the customers who use prepaid cards, broadly speaking, and you risk shoving people out of being able to economically serve these customers, particularly at anything sub-massive scale.
So what I wanted to do, thank you for giving me the segue, which is to say, what are your thoughts about the rule and what will happen in the industry? Both you can talk about your own business or overall. So Alex, anything to add? And then we'll go down the panel and then we'll break for networking and you guys can chat and ask questions individually. So
I mean, I think from our core product that we offer today, because we already offer a product that's largely in compliance with the rule and in fact goes beyond the limits of the rule in many cases, we individually, not speaking for the industry generally, will not need to update our core product substantially, and so it won't cause us a great deal of headache or cost or consternation to address it. As far as limiting the use of prepaid as a platform for innovation for innovators in financial services, particularly in a world where there are new bank charters and there are new companies trying to offer financial products to consumers, I think it will have a substantial effect on the rate of innovation. It will increase the cost and the capital requirements necessary to bring a product to market effectively and decrease the likelihood that we'll see potentially consumer-friendly innovations make it to market in a way that can either be copied and percolate through the system or where those entities can survive on their own.
Brian.
I think it'd be great to have the certainty of a final rule. Although prepaid is highly regulated, I think I could name 8 or 9 different regulatory agencies that regulate different aspects of prepaid. When you hear the director of the CFPB say that there's no consumer protections on prepaid, which is so far from the truth, once we have a final rule, there'll be certainty with consumers, I think, that this is a regulated product, although it has been all along. I am concerned about various aspects of the rule. There's a lot of good things in here, and then there's other things that I think they've gone a little too far in the interest of making sure that there aren't any cracks for any products to fall through. So, I mean, you can look at that just with the scope of the rule. Instead of saying that we want to regulate these 3 or 4 products, it's we want to regulate the entire swath of prepaid accounts, and then we'll give some exceptions and pare it back. And so I do have some concerns about how that plays out. I know that several of our members who are third-party issuers have had a very unusual thing happen over the last 6 months as program managers are understanding the rule and trying to get their arms around what might be in the final rule. They're reaching out to issuers saying, what if I switch this program around and not offer it as a prepaid program but as a debit program? If I can absorb the cost of the paper statement, am I better off because of the different regulatory environment between the 2 products? Because now all of a sudden, although you're talking about providing a lot additional protections for prepaid accounts so that they're similar to debit accounts, when you read through the rule, there's a different set of rules. I think Tom nailed it with the disclosures. We're not requiring short form and long form for checking accounts. There's a whole different set of disclosures there. But as these rules become more onerous for prepaid, a lot of program managers are looking at it saying, well, am I better off offering a debit-based product? So it's going to be interesting to see how the final rule shakes out and where it lands as to where people, innovators are launching new products, whether it's going to be debit in the future or prepaid will continue to grow.
Barry?
And I guess when it comes specifically to GPR, I sit there and I say, well, first of all, it's great to have clarity, to what the rules are and engagement should be. But I sit there and I say, we're going to try to offer a product, a financial product that serves our customers in the most possible ways. So whether it's prepaid today, whether we switch over to a debit platform tomorrow, we're still going to try to offer the same product. We're going to try to reach the consumer directly in many ways. So we're not going to be stuck in bank branches. The consumers, young people, they don't even use bank branches. So we're all just whether it's a checking account or a prepaid card, we're all just trying to get to a place where we can all offer overdraft, we can offer bill payment, where we can offer a financial product, put loans on it, everything.
Okay. Tom?
This is a great situation of be careful what you ask for, because in the years following the enactment of the Electronic Fund Transfer Act, who might have supposed that debit cards would be so widespread and within a generation, and soon after that, that general purpose reloadable prepaid card, also a mouthful, would be recognizable to many individuals as a discrete product. If the Bureau does adopt a final rule that establishes a framework that's sufficiently clear to ordinary consumers and to the participating financial institutions that can shape products in order to provide the product to a broader scale of consumers, you mentioned the scale, then we're faced with a situation where this new rule might present dramatic effects for our banking system. We have a situation now in the United States wherein the Federal Deposit Insurance Corporation is taking a keen interest in funds placed in an insured depository institution by way of a prepaid card and imposing a higher deposit insurance premium because those funds are brokered deposits. So what happens if this product goes to scale? I think members of Congress will take a clear interest in what the tax is essentially for the deposit insurance fund, and what the interaction is between the branch of the community bank and the credit union, who sees that funds are being squished around to the point that attracting steady deposits when now the consumer can attain a prepaid card for $5, load up a bunch of money and have the value retained and know where to go, because the contracts are posted online. So even if the consumer loses the agreement, the consumer can go back to the Bureau's website and learn how to notify the bank, etc. This is a complicated banking environment.
I just want to add one more point that the more that, the older I get, the more I see that I don't know that people see the value in having checks in the float anymore.
Right.
I mean, we all use cards.
That's right.
There, and the problem with checking account to the unbanked people was they never can manage the float and the overdraft. So why don't we just get rid of, when you put a check and you write a check and you do it online and it automatically, it just clears, and forget rid of the float time. Right? And I think we'll all basically end up with a prepaid product in essence.
All right, well, I want to thank you all to our panelists for a very in-depth discussion, as well as for the audience. And we have some more time for refreshments and networking and individual questions. Thank you very much.